Next question. A call option on gold with exercise price of rupees 26,000 per 10 gram. So 10 gram is the underlying asset. An exercise price is 26,000 and 3 months to expire is being traded at a premium of 1010 per 10 gram. So the premium amount is given ready made to us in the question. It is expected that in the 3 months time the spot price might change to 27,300 or 24,700 per 10 gram. So U and D, up price and down price is given. At present the option is at the money. So this is an important word. The option is at the money. Now what do we understand with the term at the money? It is something like this. Everybody is requested to pay attention. Whenever option is worth exercising, it is given a name as in the money. If at all the option is not worth exercising, it is called out of money. And when there is a situation that spot is equal to exercise, then in that case it is given a name as the at the money. These are the technical words that we have. So here, say indirectly the information is given to us like this, that the spot price of the underlying asset is 26,000 rupees. The question says that say at present this option is at the money. With this we have to understand that the spot is equal to 26,000. That is what we understand. Just for understanding purpose, we understand that over here this is given a name as like in the money, in the money, in the money. This is understood to be out of money, out of money. And so suppose the spot price of the security is equal to the exercise price, and when we write in the front, that is given a name as at the money. And the rate of interest with the simple compounding is 12% per annum. So rate of interest is given. Is the current premium for the option is justified? Means we are required to compute the equilibrium premium, and that equilibrium premium will be compared with the actual premium. This is the actual premium which is going on in the market. Whatever the premium that say we compute is considered to be the correct premium. Suppose the answer that say we find is 1500 and this is 1010. Then in that case we can say that the option is undervalued. Why? Because the premium amount is less. Suppose the answer that say we find is 800. Then in that case this is considered to be overvalued. Evaluate the option and comment. So we are required to make the computation of the premium, and based on that say we are required to pass comment. Friends, over here we can see that say the information is given about the up price and down price. The question is silent about which method is required to be adopted for the purpose of premium calculation. There are two methods that say we can adopt. One is the binomial method with the replica portfolio method, and at the same time say there is say another method called risk neutral method. How to make the computation with the risk neutral method, that we will understand later on. So far as we have studied the binomial method, so I am suggesting for the time being to do answer with the binomial method. Once we will complete the risk neutral method, I will explain with the risk neutral method too that how to do this example. Let us answer for the question. In that, write down first point. Option is considered to be in the money, comma, if option is worth exercising. Full stop. In bracket write down situations when we write yes in exercisation column. Second option is out of money, comma, if option is not worth exercising. Full stop. In bracket write down when we write no in exercisation column. Third option is at the money, comma, if spot price and exercise price are same. Full stop. With paragraph write down, we understand that spot price of underlying asset is rupees 26,000. Full stop. Sorry, comma, as option is at the money right now. Full stop. We have been given option premium rupees 1010 and at the same time we have to find option premium, comma, it means we have to find equilibrium premium. Full stop. As information is given about up and down price, comma, we can adopt a binomial, b risk neutral method, full stop. Write an answer along with me. Now see, as a student you need to understand that say this is a kind of question which is asked in examination carrying 5 marks. In my opinion the question is not so difficult. However, yet if at all there is a mistake on your end, try to have analysis of that mistake. In my opinion, say there is no new point that we have, yet if at all you have not been able to solve it, then just see that say where you have committed a mistake. See, the kind of material that I have drafted is that for the binomial method, I have done approximately 3 practice questions with you. None of these questions was asked in examination by institute. Now we are doing a question which was asked by institute in examination now. So you just have to have the self-analysis, maybe a computational error, maybe you have not read the information of the question properly, maybe you have not been able to apply any of the concept properly. Then in that case where there is a lacuna, that's say you have to make sure that say you understand it properly. Let us step number 1. Calculation of hedge ratio. Spot price is provided to us as 26,000 because I told you that today spot and exercise are same. The price of the security may increase to 27,300. So here it increases to 27,300. Price of the security may decrease to 24,700. So now we'll compute the difference of both of them. So 27,300 minus 24,700, that comes to 2,600. This is the market price. Payoff. Okay, we understand that say it is call option. So call option is exercised when the spot is exceeding exercise. What is exercise? It is 26,000. So we understand 27,300 minus 26,000. That comes to 1,300. In the next case, the payoff is 0. Why? Because the spot is less than exercise. So the difference between payoff is 1,300. As far as the hedge ratio is concerned, hedge ratio is difference between payoff upon difference between market price of the share, that is difference between market value of underlying asset. So it is 1,300 divided by 2,600. That comes to 0.5. That is the hedge ratio. Today, call option seller will borrow rupees Y at the rate of 12% for 3 months. because you can see that so the time period is 3 months provided to us. So call option will seller will borrow rupees Y at 12% for 3 months, comma, will collect premium rupees X and will invest in 5 gram gold. How this 5 gram is calculated? It is 10 gram into 0.5 because the option is sold for 10 gram gold. Step number 2, calculation of value of Y. In the breakdown, call option seller will have A, liability to call option holder if he exercises his right. B, holding 5 gram gold. C, liability to repay loan rupees 1.03Y. How this 1.03Y? Y plus Y into rate of interest is 12% into 3 divided by 12. That is the way we will have the repayment of loan. The market value of 10 gram gold will be either 24,700 or 27,300. So 24,700, 27,300 and 27,300. I am writing the 27,300 for 2 times because on request of students I give explanation by both the methods. I go column wise. Exercise question mark. In the first case it is no, it will not be exercise. Why? Because the spot is less than the exercise. So now sale 5 gram gold in spot market. So what will happen? It is 24,700 divided by 10 into 5. Why? Because the hedge ratio is 0.5. So I think that it comes to 12,350. Then in that case we will have less repayment of loan 1.03Y. Considering the overall profit or loss 0 will make the calculation of Y. So you can see that the calculation is very simple. If at all you take the no exercise price, say that column, once you have the value of Y, we can compute the value of X as balancing figure. In case of 27,300, whether he will exercise? Yes. So sell 5 gram gold. So 27,300 divided by 10 into 5. That comes to 13,650, I think. Then less payment of payoff. What is the payment of payoff? I think that it is 1,300. Again, it is 1.03Y. That is the way we will have, say, the value of Y to be computed. The last method, in that case again, the option is exercised. So he comes to your residence call option holder. So in that case we understand that say amount received equal to exercise price. What is the amount received? Amount received is an amount of 26,000. Okay. Now what will happen? We understand that say amount received is 26,000. You already have 0.5 gram gold, so you have to buy 0.5 gram gold. So less purchase 5 gram gold from spot market. So we understand that it is 27,300 into 0.5. That comes to 13,650. The repayment of the loan will remain same, 1.03y, and with that, so the overall profit or loss will be taken 0 for the purpose of calculation of the answer. So we understand that so the net profit or loss is 0. So in the first case it is 12350 minus 1.03. In the second case you can see that 13650, that is this value, minus 1300, that comes to again 12350. In the last case it is 26,000 minus 13650, that is 12350. So every time it is going to be 12350 only. So write an answer. 12350 minus 1.03y is equal to 0. So 1.03y is equal to 12350. Value of the y is 12350 divided by 1.03. So answer is 11,919.29. Step number 3. Calculation of value of x. Let us see that's how to find the value of x. We understand that so the x plus y is equal to 26,000 into 0.5. So x is equal to 13,000 minus 11,919.29. So 13,000 minus 11,919.29. So it is 1,009.71. Or we can say it is very near to 1,010. That is the premium. Now friends, actually premium amount is provided to us in the question is the same 1,010 only. You can see. So what happens at say actual premium is same as the equilibrium premium. That is the reason that we understand that say the option is correctly valued. So the right answer. Actual premium is same as equilibrium premium so option is correctly valued. Full stop.